If you've been following along with my videos up to this point, you probably have a good sense for what your net worth is, as well as what your cash flow might be. But are you really seeing the full picture yet? In this video, I want to talk about some of my favorite ratios you can use to dig a little deeper into your metrics and get a better sense for where you stand. They'll reveal how healthy your finances really are, and I'll discuss how to use them to spot problems early, make smarter decisions, and make sure you're staying on track for your financial goals. By the end, you'll walk away with a few simple, reliable ways to measure your financial progress with clarity and confidence. Welcome to Refactor Your Money. I'm Max, an accredited financial counselor, here to help you break free from financial stress and live the life you deserve. Today, I want to walk through 7 of my favorite financial ratios that you can use in addition to your net worth and your cash flow to better understand where your finances stand today and where you want to take them going forward. So let's kick it off. For each ratio, I'm going to tell you first what question about your financial health it's going to answer for you. Then I'm going to run through how to calculate it. And then lastly, I'll go into a little bit more detail about some of the nuance around what it actually means for you. Let's start with the asset to debt ratio. This ratio answers the question, will what I own cover my debt obligation? The calculation for asset to debt ratio is pretty simple. You take your total assets and you divide it by your total debt. At the end of that calculation, you'll be left with a number that represents the number of times larger your total assets are than your total debt. In other words, if that number is less than 1, it's a good indication that your assets are less than your debt, or you owe more than you own, right? If you were to sell all your assets today to clear off all your debts, you would still be at the mercy of your creditors because you would have a balance left over. A result of 1 indicates exact parity between your assets on the one hand and your liabilities on the other. In other words, they share the exact same value. And a number above 1 indicates that you own more than you owe. If you were to sell off everything and pay off all your debts, you'd be left with a little surplus, a little extra there at the end. If this number is even greater than 1, 2, 3, 4, 5, that's even better. You want this number ideally to be going up over time. You want your assets to be growing as you grow older, and you want your liabilities to be coming down, right? So the delta between those two numbers should theoretically be growing. That was not very, let me try that again. Should be growing, right? 1 going up, 1 going down. That's a little better. So you should see that number going up. Next up is the solvency ratio. This one answers the question, how susceptible am I to going insolvent? Now, as you might remember from the discussion about net worth in a previous video, solvency is just another name for how susceptible are you to being at the mercy of your creditors, right? If your net worth is negative, it means you're insolvent. If your net worth is positive and you own more than you owe, you are solvent. So the solvency ratio is going to help you determine how susceptible you are to slipping into insolvency. It's calculated by taking your total net worth, the baseline number at the bottom of your net worth statement, and dividing it by the total assets from that same net worth statement. The number you're going to have there at the end is going to be it's going to be a decimal, less than 1, and it's going to be a representation of how much loss in value your assets would have to have before you would become insolvent. So, for example, let's say your net worth is $10,000 and your assets are $100,000. If you take $10,000 and divide it by $100,000, you're left with 0.1. What that basically means is you have enough debt or a high enough balance on your liability side of your net worth statement that just a simple 10% decrease in value in your assets is going to make you insolvent. So obviously you want that number to be higher, right? If you multiply it by 100, it's a percentage point. You want to be as close to 100% or as close to 1 as you can get it. A number of 1, a result of 1, or 100% would basically mean that you have no debt. You have only assets, no debt, and there's basically no chance you're going to become insolvent. Even if all your assets went down to 0 because you have no debt, you still wouldn't be insolvent. So much like with asset to debt ratio, you want this number to be going up over time, right? You want the number of assets, you want the percentage to which your assets make up your net worth to be growing. You want your assets going up, again, liabilities going down. That will help increase your solvency ratio and reduce your susceptibility to insolvency. Next, let's move into the cash flow side ratios. These ones are going to help you get a sense for how healthy your cash flow is on a month-to-month basis or an annual basis, if that's the way you measure it. Let's start out with liquidity ratio. Now, the question this ratio answers is, do I have enough cash on hand to absorb an emergency scenario? It's a pretty basic calculation. You take all your monetary assets, which is defined as anything that's cash or a cash equivalent, although in an ideal world you have this cash saved in a savings account, checking account, or it's actual physical cash. You take that amount and you divide it by your monthly spend. And the number you're going to be left over with is a representation of the number of months you can go only living on that cash with no other income. Now, the ideal recommendation for this is between 3 and 6 months. Now, I think that can depend on your scenario. I think if you're a 2-income household where both people work full-time, like this often is the case with midlifers like myself, my wife and I are like this. We have 2 different incomes, 2 different full-time jobs, and even if one of us lost our job, the other one pretty likely is going to be keeping theirs. It's a pretty unlikely scenario we're both going to be laid off at the same time. Now, it's not impossible, but it's not likely. I think in a scenario like that, 3 months is a more acceptable amount. You can trend closer to the 3 side of that spectrum. Now, if you have a 1-income household, or there's just a single earner with 1 stream of income, you might want to push more towards the 6-month side of that spectrum. And that, again, is to reduce the risk of that one person being laid off from their job and all income disappearing. And obviously, there's other ways to make income. People have multiple income streams. In fact, that's the whole goal of this channel, is to help you learn and grow in your finances and eventually start developing multiple streams of income. But often starting out, we just have our jobs, right? So again, you want to shoot for between 3 and 6, trend towards 6 if you're a single income household. You can trend closer to 3 if you'd like. It's a little riskier, but it's acceptable if you have multiple streams of income, multiple people earning salaries or wages. Next up is the debt-to-income ratio, sometimes referred to as the back-end ratio. Now, the question this one helps answer is my total debt burden too high? The calculation, again, is pretty simple. It's total annual debt payments divided by gross income. Now, gross income is your salary before payroll deductions, tax withholdings, and any other retirement contributions you might be making. So when you go to your employer, say, what's my salary? They give you that top line number. That's your gross. That's the number you use for these calculations. Essentially, what it represents is a measure of your indebtedness relative to your income. It's a number that you want to decline over time, right? So as your salary grows and you pay off your debts, you shouldn't be replacing those debts with new debts, right? As your income grows, you want to avoid lifestyle creep. You want to avoid your expenses rising with your salary, and you want to try to keep your debt load the same or lower over time, which will thus reduce this ratio. Now, this number is used, debt to income, or DTI as it's sometimes known, is often used by mortgage lenders when qualifying an applicant for a mortgage loan. And the number they look for is 36% in general. Sometimes it'll vary based on the lender, but the general rule of thumb is 36% or less for debt to income ratio. Next up is the housing ratio. This one is sometimes referred to as the front end ratio. This one answers the question, are my housing costs too expensive given my income? This one's measured by taking your total housing expenses, which is generally considered your principal, interest, taxes, and insurance, or PITI if you already own a home, as well as any HOA fee or homeowners association fee you might incur on a monthly basis, and dividing that by your gross monthly income. Now, what this number represents is a percentage of your income that's allocated to housing expenses. Now, mortgage lenders generally expect this to be 28% or less when qualifying applicants for mortgage loans. And what I will sometimes recommend, and I did this for myself, is to also include some of your phantom housing costs. So if you already own a home or you're responsible for any types of repairs in your apartment or whatever, you're going to want to include some of that stuff. So any allocations per month you're making towards replacing a roof, or if you have to pay for landscaping, or any additional costs that might not be wrapped into the mortgage or the escrow for your taxes and insurance, you can wrap that into the number to get an even clearer picture of your total housing expense for a month, not just the baseline fixed expenses. Next up is the debt payments to disposable income ratio. Now, this one's a little self-explanatory, but it basically answers the question, are non-mortgage debt payments too high? Now, this one's calculated by taking your non-mortgage monthly debt payments and dividing it by your net monthly income. So this time, not gross, net. We're measuring disposable income. So what's left over at the end after all payroll deductions, after all tax withholdings, after any retirement contributions. So the money you see on your paycheck when you get it every 2 weeks. And it represents the percentage of your income that needs to be earmarked each month for debt payments before you can use it for any other purposes. Now, you want this number to be as low as possible. Now, I'm often asked the question, what is consumer debt in this ratio? What does consumer debt represent? Well, credit card debt, of course. But really, it is any non-mortgage debt, and that includes student debt. So we do consider student debt non-mortgage consumer debt for the sake of this ratio. Now you want this number to be as low as possible. 0 is ideal, right? We want to shoot for having absolutely no consumer debt at all. But it's obviously not the case. For most people, especially midlifers like me or you, we often do carry some amount of debt. Could be a car loan, could be furniture loan, could be a personal note, or student debt, which is very often the case for many of us. So anything less than 15% is considered acceptable. Once you get to 15 or higher, that's when things start to become problematic. So that's when you really do need to start taking some serious action and starting to make some changes. So that's debt payments to disposable income ratio. Next up, and perhaps my favorite, is savings rate. Now, the reason this one is my favorite is because it has so many implications for your long-term financial health. And it answers the question, how much am I saving for my future? Or in other words, how big is my financial shovel? Now, it's a pretty simple ratio to calculate. You basically take a look at your cash flow statement, you see what any surplus at the end might be, and you divide that by your total income from the top part of the cash flow statement. That's going to leave you with a percentage, and that's going to represent how much is left over at the end of each month in comparison to what you're earning. So, for example, if you earn $10,000 a month and you're able to save $1,000 of that $10,000, you have a 10% savings rate. Now, the thing I love most about calculating savings rate and why it's my favorite ratio is that if you tweak your mindset a little bit about what it means, it can really, really light a fire. At least this is what happened to me. It can really light a fire in terms of how you see your savings rate and how you motivate around saving more money. So let's use an example to illustrate this. Let's say you make $10,000 a month and you need $8,000 a month to live on. So you're able to save $2,000 a month at the end of the month. Now, if you need $8,000 to live on, if you want to replace that $8,000 each month with some other source of income, you're going to have that saved or stashed or generate that from some other source, right? You're going to leave your salary or wage behind. You're going to live off $8,000 from some other source. If you can save $2,000 in a month, you now know you need that every 4 months of work, you are saving yourself 1 month of retirement, right? So you're saving $8,000 over the course of 4 months. 2 times 4 months, 2,000 times 4 months is 8,000. You need 8,000 to live on. So for every 4 months you work, you've earned 1 month of retirement. But let's say you can increase that number to 50%. So your savings rate goes up to 50%. So now you're bringing in 10,000, but you only need 5,000 to live on. Now, every month you work, you're actually earning yourself a month of freedom, right? The month you're living off 5, you're immediately replacing with another 5. So each month you work, you stack up a month of freedom. So increasing your savings rate can really have a seriously meaningful impact on the amount of time it takes you to reach retirement, and it can shorten it significantly. So focusing on savings rate is huge. Now, the conventional wisdom for savings rate is anything above 10% is acceptable. So again, 10% baseline. If it's less than 10%, you got some work to do. It's time to get serious, time to make some changes and start saving some money. Between 10 and 25% is an acceptable rate. That's pretty good. As long as you're saving that and investing that and it's growing over time, you're going to be in good shape. Anything above 25%, you're really setting yourself up for accelerating that retirement and really, really shortening your working life. Okay, so now that we've gone through each ratio and I've done a little bit of explaining about what questions they answer for you, how to calculate them, and giving you a little bit more context about what they really mean for you, let's jump into my sample template here and I'll go through the ratio calculations I have in there so that if you download it and use it for yourself, you understand how to start tracking it and updating the formulas if you need to. Okay, here we are back in my personal financial tracking template that I've shown in my last couple of videos. You can see a rundown of this in both the net worth statement video and also the cash flow statement video, but I wanted to jump in here and just show you one more time how the ratios work in here, because now that we've discussed ratios and you have a better understanding for what those mean and how to use them, I wanted to make sure you understood that they were in here. So we're going to start off on the net worth tab down here at the bottom. And if I scroll down to the bottom, you'll start seeing that there are some ratios down here. So again, we're down on the net worth tab. The bottom of the columns, there's these ratios here. There's 2, asset to debt and solvency. Now, we've discussed what those mean. Those are net worth based ratios, but I just wanted to show you that these rows can be used to track and calculate that. So the asset to debt, as we discussed, is literally just the total assets divided by total debts. So that's 627,025 divided by 339,831. So that one just gives you a sense for how much of your assets are capable of covering your debt load, right? So you have 1.85 as much value in assets as you do to total liabilities. There's also the solvency ratio here. This one, as we discussed, represents the percentage decrease by which you would reach a percentage decrease in your assets by which you would then reach insolvency. So if I just click into the formula here, you can see that it's the total net worth divided by C73, which is the total assets. So that's just generating you a 0.43, and what that 0.46. And what that basically means is that if the total assets were to decrease by 46%, the value of your assets would now equal the value of your liabilities, and you would basically be teetering on the edge of insolvency there. So it just gives you a sense for like how open you are to value loss risk of your assets or depreciation risk. So I talked a little bit about the thresholds here. You'll see that these are color coded. So green represents healthy. So anything above the threshold I mentioned in the previous segment of this video would be green. Anything in the acceptable threshold will be highlighted yellow. And if you fall into a danger zone or something considered problematic that needs immediate attention, that will highlight in red. So as you fill in these additional columns, as you track your net worth month to month, and you fill these columns in, these ratios will calculate automatically. Those will fill in as well. And so will these graphs at the bottom. You can see down here, there's a graph. This is the ratios graph. This one tracks both the asset to debt ratio that I've already discussed, which is right here, and the solvency ratio, which we've discussed here. And basically, as you fill in columns, these data values, so because we only have columns 1 through 3 filled in, you'll see there are only data values for the first 3 y-axis values here, 1 through 3. But as you fill those out, those will then also fill out automatically, and the trend lines will adjust. So as you can see if you're tracking up or down over time with those. And then one last helpful tool that I actually don't think I covered in the previous videos is, actually, you know what? That's on the cash flow tab. I'll show you that on the cash flow tab. So we'll flip over there real quick. Similar thing going on here. We've got all the ratios that we need to worry about down here at the bottom. So as you fill in additional columns here, these ratios will fill in. We've got liquidity ratio, and again, that one represents the number of months of an emergency that you can absorb based on the amount of monetary assets or cash that you have available on hand. So this is the only ratio in this list here that's actually going to pull a value from the net worth tab. So you can see it's pulling C24. If I flip over there and show you what C24 is, you will see C24. So that is going to be total cash. So you see that right here, 43,200. So it's pulling that here for value 1. You'll see if I flip over here, it's going to be column D instead of column C. So as you fill in these columns in both net worth and in cash flow, these numbers will calculate. And you can see here between month 1 and 2, this person went from the acceptable range into the healthy range, where they now have over 6 months of emergency fund available to them. Then we have debt to income. This is the one whose threshold is 36% or below. This is the one that lenders will often use, and it answers the question of how much debt load do I have overall? Is it too much? Or is it adequate? So that's debt to income. There's also housing or front-end ratio, which is how much of your housing costs represent how much of your income is going to be allocated to housing costs. So that one you'll also see is based on a formula here. We've got C29, 23, and 28. So I actually just cherry-picked a few rows. So mortgage or rent, and then HOA dues and home insurance. So while this is generally meant for mortgages, you can also use it if you're a renter, just to get a sense for how much you're spending on rent relative to your income, or housing in general, even if you don't own the property. So there's that one. Again, this one's all in healthy range. Debt payments to disposable income. So this one, again, as I mentioned previously, is a measure of your consumer debt. So that would be credit card debt, of course. If you have maybe like an auto loan, or if you have student debt, so that's all included here. You can see if I scroll up to C20 through C22, you will see that. So that's all these 3 right here: minimum credit card, minimum student loan, and minimum debt payments for other. And this is where you might put like an auto loan or a personal note if you have anything like that. So any of these 3 columns are being pulled into that calculation. If you want to break these out or add more, you can. Just be aware that the formula is based on those 3. So if you were to adjust or add or delete rows, just double check the formula that it's still going to be working based on how you've split it out. And then base savings rate and advanced savings rate. So these are two ratios, and these are actually based on a couple of additions I've made to this spreadsheet since the last video. In the income section, I've actually added two totals here. So there's a subtotal, which excludes retirement contributions. So if I open this up, you'll see that this is actually only including C5 through C12, but C13 has this payroll retirement contributions value. So that is reflected here in the total. So if you want to include payroll retirement contributions as income for you, even though it isn't technically cash available to you in your paycheck to spend, you can do that here, and it's included here as is by default as the total. But if you do want to work off of the subtotal here that excludes all of that, I give that to you here on line 14, row 14, and that's how these are split out. So the base savings rate is going to be calculated based on your total up above, including retirement. Advanced is going to be once you get to a high enough income where you want to start excluding that, maybe like 150,000 or so. That's when you're going to want to start going off of the non-retirement income. So you'll see here, if I click into this, it's using C14, which is that subtotal value, not this one will be using the C15 value. Yep, there you go. So that's what you use there. And you can track these as you progress, and the background highlighting will change color based on the thresholds I discussed in the previous part of the video. And then you've got the charts here. So liquidity over time. This one is a standalone, and I did it that way because it's the only one in the list that does pull from the net worth ratio. So it is dependent on net worth. So that one here, you can track that. This is your emergency number of months that your emergency fund will cover of your spending. Again, as you fill in more columns, more plots will fill in here as you go across the y-axis. And then you can also track all your ratios over time here. So again, as more columns fill in, as you fill in more months over time, these values will also update and fill in, and you can start seeing and tracking how your ratios are playing out over time, and start making adjustments or use that for decision making if you need to. Like if you're saving for a down payment on a house or whatever other financial goal, and you want to make sure these ratios are within acceptable limits, this will help you do that. And then finally, getting to the thing that I did not mention in the cash flow statement video, but I want to mention here is that I do also have total and average columns here at the end in columns O and P. Those are there to help you understand your total income for the year and also your average per month income for the year. So obviously incomes might change throughout the course of these 12 months, and same for spending. These values are just here to give you averages and a total, so you just get a sense for, like, if you're going to run like a retirement calculation or some other calculation that requires knowing what your spending was for the year or is on a monthly basis, those are here and available for you in columns O and P. And then you can also see what your average ratio was over time for the course of the entire year. So here you're getting your month to month, right? You're tracking, let me scroll up so you can see this better. You're getting your month to month here. So each month you can see what it was. And then if you go over to the far side, you'll get an average for the whole month, or sorry, for the whole year. There is no average here. Again, because there's no average net worth calculation on the net worth tab. So you can't really have an average liquidity ratio because there is no average net worth in that tab. But these other five you can get pretty easily just by averaging out the values from the year. So I hope that's helpful. If you want this spreadsheet and you want to download it, I have it available in the description below. I'll talk more about that in just a second. But that's about it. I just want to run you through this, give you a sense for how it works, and I'm now going to jump us back to the main video. So I'll see you over there. Thanks. So there you have it. I hope that was helpful. I really just wanted to take some time to do a dovetail off of my previous two videos about net worth and cash flow to talk through ratios, because I really do think once you get your cash flow number and your net worth statement all figured out, you've got those baseline numbers, it really is helpful. And it was for me, at least. I think it will be probably for you to start diving into some more specific metrics around those. And those 7 ratios I ran through are a fantastic way to do it. So I hope you're coming out of this video with an understanding of what the ratios do, how to calculate them, and how to use them going forward to help make better decisions, get some clarity around where you want to go, and help push you towards your goals. Before I let you go completely, I really hope that you will take some time to comment below about what you thought of this video, or if you have any obstacles or any hurdles that you're facing yourself with your money that I can help you with. I would love to be able to do that. I'd love to make future videos that help you rather than making videos that are just what I think is cool. And then if you want the spreadsheet that I showed, just now. It's available in the description below. I put it down there as a link. So you can go ahead and click that link, fill out the form, and I will send you access to that template. You can use that for yourself to start tracking your own progress. And then I also have a link for a 30-day money refactor down there as well. That's just my step-by-step 1-month guide to help you gain a little bit of clarity about where you want to go with your money, where things stand now, and just give you an idea to just get you to start percolating some thoughts about what your goals might be and what changes you might want to start making. So super easy, like I said, step-by-step, totally free. Click the link below if you're interested. And then lastly, if you would like a little bit of extra one-on-one attention, you want some time to chat a little bit with me about your specific situation, I am an accredited financial counselor. I would be happy to meet with you. There's a scheduling link in the description as well, where you can schedule a 50-minute focused one-on-one coaching session with me. It can be one-on-one, just me and you, or it can be me and you and your spouse if you're married and have a family, or your partner, whatever it may be. Happy to help with that. So please do go ahead and click that link and get that scheduled if you're interested. I love helping people out. Personal finance really is personal, so I try to give all the tools and tips and advice that I can. But really, it does sometimes help to just have a personal call. So if that's you and you're interested, go ahead and click the link below. And then finally, I plan to release a video a week going forward. So if you got any value out of this content, I would love it if you would like and subscribe. That really does help me to be able to create more videos and continue to bring more value to you going forward. So please do that. And beyond that, I think I'll let you go. That's it. I really appreciate you watching. I hope I've been able to bring you some value. I hope this was valuable for you, and I will see you in the next video.